Good evening, everybody. Hope everybody's having a nice summer evening. Do you realize just we're less than a week away from the longest day of the year? The longest daylight, anyways. All right, tonight again we've got the great pleasure of having Mark Sebastian with us. He's a former member of the Chicago Board of Options Exchange and the American Exchange, and he's now the Chief Investment Officer of Carmen Line Capital. So his topic tonight is trading the VIX and the VIX ETFs. So imagine with all aspects of how to trade them. So with that, Mark, it's good to have you back again. We're anxious to see your information tonight.
Oh, thanks, Steve. It's great to be here. Always a pleasure. Steve's one of my favorite people to hang out with and to spend time with, and he's got a great crowd, so I'm happy to be here. So I loaded up the slides already, so I'm going to start the slides here, and we'll let me see. I'm going to pull them up. I guess I got to find them, right? Or are they? Or is these the ones? Are they already loaded in? Can everyone see the slides? Is that what it is? Or do I need to press the Start Slides button?
I don't know. I'm seeing your trading VIX and the VIX.
Okay, so you can
ETF.
see it. All right. Good.
Yep.
Well, then we're good to go. All right. So good to see everybody. Reminder, the whole standard risk, blah, blah, blah. Risk, 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 risk. Basically, all these legal things say if you lose money, it's your fault, not ours. Just long story short. All right, and that's what this says. So again, Steve gave me a little intro, but that's me. I was a trader on the floor for about a decade between the Amex in New York and the CBOE in Chicago. After that, I started Option Pit. We're an education consulting company. We work with individual students, teaching them how to trade like professionals in the option space. And we work with funds, money managers, hedge funds, helping them implement and optimize option strategies. Well, lo and behold, I kind of got sick of helping other guys make money trading in a fund structure, and thus we started Carmen Line Capital. Carmen Line Capital is a hedge fund. We specialize in trading volatility products and the S&P 500. That's about all I can say. If you want information and you're accredited, you can email me, marketoptionpit.com, about it. But one of the nice things is we're going to talk about the VIX today. I've got a pretty extensive discussion here. I'm going to get into what is volatility and what is the VIX. I'm going to talk about the ways to trade VIX, ways to trade VIX ETPs, and I'm going to have some strategies to think about trading each of them, how to kind of set up trades, and some different ways to do it. And I know a lot of people are aware of some names like VXX, but there are all sorts of. What's the difference between an ETP and an ETF? Well, an ETP stands for exchange traded product. So an ETF is a type of ETP. There's also something called an ETN, which is an exchange traded note that falls under that category. So we use the term ETP because it's kind of all-encompassing. And VIX products have ETNs and ETFs, so it's easier for me to just say ETP. But good question. So volatility is a measure of movement of an underlying instrument over a period of time regardless of direction. All right. So it's really variance over a time series is the way I usually describe it. All right. The higher the volatility, the higher the movement and or expected movement of the underlying. All right. when I discuss volatility, no matter how long the expiration, the number is an annualized number. So if I pull up an implied volatility on the S&P 500, which has options expiring in the morning, all right, basically we wake up tomorrow, the bell rings, the options expire. Those do have an implied volatility assigned to them. That implied volatility is an annualized number. All right, it is not just what it's going to do tomorrow. Right, there are three main types of volatility that we can look at. And they're actually somewhat related to, and one of the reasons I like candlesticks so much is because they can allow us to get a full view of volatility. Historical volatility is how much an underlying has moved in the past over a set number of days. So when I'm looking at volatility, at historical volatility, I look at the last 10 days, the last 20 days. I'll look as far as the last 360 days. And that's telling me how things have moved in the past. And it's usually measured closing price to closing price. Right? So if I'm looking at volatility with closing price to closing price over the last 20 days, where do you think I gather information from candles? What is one of the things that are so great about looking at a candle? Bueller. All right. Well, if you look at a candle, you know, I'll pull one up here in a second. Not what I was trying to do. You look at a candle. Here, look at this. All right, so you've got some big candles. Yeah, it tells you the move. There you have it, Bill. It tells me the what the movement was from open to close. I get more of a complete picture looking at candles with a look at volatility, historical volatility, to get an idea of, okay, well, here's part of the picture. The candle gives me the entire picture for the day. So I now know, okay, yeah, it closed relatively unchanged, but it actually moved a lot. All right? That's important. All right? The next one, and this is actually very similar to historical volatility, and that's realized volatility. And consider that kind of the extreme recent past. So what is happening right now? All right? What is happening today? What has happened the last hour? You know, think of, when I'm looking at realized volatility, I'm looking at a number of ticks. I'm looking at a day or two of movement to kind of get a feel for what's actually happening. Then there is implied volatility. Implied volatility is how much the market is expecting an underlying to move over a future set period of time. Right? So it's not how much an underlying is going to move, it's how much the market thinks an underlying is going to move. And there is a very big difference. All right? The market is wrong a lot. So implied volatility is our best guess of what might happen. All right? So what makes trading stocks so different than trading volatility over the long term? And the main concept is that implied volatility has a mean reverting characteristic. So this is a big long chart of Apple, a couple of years. And you can see that its 50-day and its 200-day do not appear to have a mean price. All right? I mean, look at the way this thing is moving around. There's no average. I mean, I guess I could draw an average, but what would that be? What does its average price of 120 have anything to do with where it's trading right now? Nothing. Now, there can be some near-term mean reversion in stocks. You know, it's moved too hard the last few days, right? And now it needs to pull back. or it's moved too short, and now it needs to, it's moved too low, now it needs to pull back. I believe that's kind of some of the stuff that you guys do here. Well, that's not really what I'm interested in, right? I'm interested in the fact that stocks over the long run don't have a mean. In the near term, sure thing. Now, this is the VIX of Apple options. Now, you tell me, does that, the red line being the 50-day moving average, the light blue line being the 200-day moving average, does that appear to have a set of what appears to be some mean reverting characteristics? If you're answering anything other than yes, you are incorrect. Correct, Ken. All right. So the basics is a stock price can go anywhere and it can stay there. Volatility can go anywhere, but it won't stay there. When volatility is at its extremes, especially on its highs, it does not stay there very long. On its lows, it can stay for a while. So understanding this can help you with buying and selling decisions. Okay. So most traders think mean reversion is an instantaneous thing. But implied volatility, like the VIX, can stay low for very long periods of time. We went through a 2.5-year period from 2012 to 2014 where kind of nothing happened. We went through from really July of 2016 through where we are now, a period of an extremely low VIX. Volatility was very low, but volatilities can also go sky high. You know, see August of 2015 when it went to 50. October of 2016, August of 2011, August of 2008. August is an extremely volatile month, by the way, guys, historically. I don't know if you guys know that. A lot of people are on vacation, so volumes are light. It is extremely volatile. And this is misspelled, but it's important not to have a recency bias. All right? And understand how high and low vol can get. All right? It is so easy to have a recency bias. Right? That's the belief that what just happened is the way things always are and have been. And that's not really the way the market moves. All right? So, generally speaking, here's the way I think about implied vol. When implied volatility is low, it can stay there for a long time. And money in options, especially premium selling, can seem extremely easy. You have no idea how often I get emails from people saying, why would all I need to do is sell credit spreads and put money in the bank. I can't lose. And then they see, you know, these 1 or 2 day shots and they get blown apart. So the thing to remember is when vol is low, it can go away extremely quickly, money. All right? So the play is to have maybe some long volatility, some long units, and be short premiums. So I like things like calendar spreads when volatility is low, where I'm collecting premium, but if implied volatility increases, it helps me. All right? I have been trading calendar spreads in the S&P 500, and it has been like it was like set your watch to it before kind of Friday. That nuts. All right, so now higher volatility, and this is where people get into trouble. All right, in a low volatility environment, rules-based systems tend to work. In a high vol situation, rules-based systems tend to stop working. All right, so when IV is high, it will fall back. All right, And until recently, spikes have been short, but some of these ones have not been. All right. IV can stay high for months. I think the next one will be a little longer. All right. IV can stay high for months and then take months to ease back. Things like long VXX can actually work. Short time spreads can be a good trade. Short butterflies can work. Short wings, not in a ratio, typically can be extremely profitable. All right, so now let's talk about VIX. The VIX is the SIBO Volatility Index. Right? And the purpose of the index is to gauge the buying and selling of options in the S&P 500. I like to say it gauges, what do you mean by short wings? Really out-of-the-money options, if you do it the right way. All right? So if you think about, when I say wings, I mean not super cheap options, but options that are out of the money at the time. Believe it or not, high vol can be an interesting time to trade strangles. It's only really selling those in low vol to turn into a problem. Or iron condors can be good in high vol situations. So, and Fred, pardon my lingo. I've got a lot of floor experience, and so sometimes my flories gets into the way I talk. I just hired a new admin, or actually not really an admin, my director of operations. And she was a floor trader for like 15 years. And so she's kind of been off the floor for a few years and now is coming back into the trading sphere and is so not used to the way the retail public talks about trading options relative to the professionals. It actually is surprising. So when VIX is up, the cost of insurance is higher and vice versa, right? So the idea is that when there's more buying over selling of options, VIX is going to go higher. When there's more selling than buying, VIX will go lower. George, ask me that at the end. All right. So what is VIX? Similar to the S&P 500, this index is not actually traded. You know you can't go out and buy a share of the SPX. You can buy a spider, you can buy a future, you can buy a basket, but you can't just go out and buy the index that is quoted. There's no way to do it. There's a lot of ways to synthesize it, though. So the VIX is essentially an estimate of implied volatility on the S&P 500 options that has a constant duration of 30 days. Constant duration means that the VIX is always 30 days to expire. It never expires. So today, the VIX was going to expire in 30 days. So 30 days from now is July 15th. Tomorrow, on June 16th, the VIX will be 30 days to expiration still, and it'll expire on July 16th, and so on. Right? The weighting of the VIX puts more emphasis on at-the-money options than out-of-the-money options. So the one thing you can know is that when the VIX starts to move, that means there's probably some demand at the money. All right? So the weighting of the VIX naturally puts more money on puts than calls. All right? Why? Well, hedging tends to push puts around more. And the VIX uses 2 weekly options closest to 30 days to expiration. It uses the 2 weekly options closest to 30 days to expiration. So if you're looking at SPX right now, and it's the Friday options, they don't use the Monday and the Wednesday options. So if you're looking at SPX right now, the SPX is looking at the June 21s and the June 14 options. Or excuse me, not June. July 14th options and the July 21st options. Those are the options the VIX is pulling from. The VIX is quoted as a price but is really a percentage. Volatility, despite not being spoken as a percent, is always a percent. So VIX of 10 is actually 10% annualized volatility. 10% annualized expected movement over the next 30 days. That is what that is. So the VIX settled today at 1090. So that means between now and July 15th, the market is expecting the S&P 500 to move on a 10.9% clip up or down over the next 30 days on an annualized basis. Here's the VIX in the last year. What's it done? Well, we've seen the VIX get over 25. Around Brexit. Right? Brexit was the peak. Right? There's peak in Brexit. And then we've seen it hit 30-year lows, which it did here. That's not a bad range, right? Over the last year, it's been over 15 points wide. From high to low. The VIX negatively correlates with the S&P 500. So in the S&P 500, the SPX is up, VIX is down. When SPX is down, VIX is usually up. You think about it, it makes sense. As generally, when the market sells off, volatility does increase. There's also the nature of similar movement against the lower numbers. So think about this. The S&P moves 10 points a day, and it's trading 2,000. How much is it moving a day? 0.5%, correct? The S&P gets cut in half. It's now trading 1,000. It moves 10% a day, or 10 points a day. I'll move it closer to my mouth. The S&P was 1,000 now, and still moving 10 points a day. How much is it moving? 1% a day. All right, 1% a day is a VIX of 16. 0.5% a day is a VIX of 8. All right, the construction of the VIX naturally causes VIX to rally when the market falls. All right, so there is also this concept of skew. And that is because there's more demand for puts to hedge, and people like you guys love selling covered calls, right? Who here likes selling covered calls? Raise your hand. We all know you do. So when you go out and sell a bunch of covered calls, that lowers demand, that lowers volatility. When big institutions hedge by buying puts, it increases demand, that increases volatility. So basically, if we're trading here, and we drop to here, even if volatility doesn't move, look at how much higher the at-the-money volatility is. And remember, at-the-money volatility gets more weighting than all the other options. So VIX can actually be up on days where implied volatility is actually down. What do you think about that? let's talk about the characteristics. VIX options and futures are European exercise. That means there is no early exercise of VIX options. You cannot be assigned early. They have a unique settlement procedure, all right, as do the VIX futures. The settlement is based on an index called VIX-MO, V-I-X-M-O, not the VIX itself. They're very similar, but VIX-MO is basically how the cash print is executed. At 30 days to expiration, VIX futures and VIX options, all right, they move at about a 0.5 beta to the actual cash VIX. So, for instance, the VIX was up 23 cents today. The July future was up, waiting for the data to come in. The July future was up about 10 cents. All right, so the July future, which is the tradable VIX, at 30 days to expiration moves about half as much as the cash VIX. And options are based on the futures, not on the cash index. The VIX futures are probably the most successful new product introduced in the last 20 years. They trade out 8 months. Each month trades independently, so not like the SPX. So an S&P 500 futures are correlated at almost 100%. VIX futures are not. The front month VIX future correlates to the cash index at about 0.5, and then the August future is going to correlate to the cash index at about 0.35. All right, now there are weekly futures, although they're lightly traded. Eventually they will, but they're lightly traded. And they're typically used as hedges against long portfolio, and they're about in contango about 80% of the time. And that is the VIX futures curve from today. Near this kind of, I pulled this at about 130-ish. And if you haven't been to VIX Central, it's a great resource if you want to kind of watch how the curve moves. But you can see June expires in about a week. The July future in 30 days. And what else do you notice? What else do you notice about these future prices? Are they higher or lower than, yeah, they are ramping upwards. Are they higher or lower than the cash index? Yeah, they're higher. They're in a contango. VIX futures are almost always in a contango because mean reversion. Traders are always afraid of mean reversion. So when VIX is low, what does mean reversion say? Well, mean reversion says that vol's going to go higher. Yeah. All right, then when vol's high, what does mean reversion say? Gonna come down. So that is VIX futures. VIX options, again, by far the most successful option product introduced in the last 20 years. Yeah. They trade out 8 months. Each month trades independently, just like they're based on the VIX future. If you want to know the underlying of a VIX option, it is the VIX future. Each month trades independently. All right. So sometimes, if you're trading calendar spreads in VIX, you actually can't get cross margining. or you get reduced cross-margining. All right? And they have weekly options that listed last October, and those do trade. Those have some volume now. Weekly options are great. And they're typically used as hedges. The volume. VIX options are super, super, super liquid. They trade hybrid and open outcry. All right, so you guys are mostly going to trade hybrid. I do almost all of my trading open outcry. So, and that's because when you're trying to get some real size up, you actually get far better pricing than you know, when you're trying to do if you try to do that electronically. And markets are tight, nickel wide usually, dime wide at the most. What is open outcry? That means I call the floor, and a broker finds the market in a crowd, and then we trade it. It is old school. I'm an old school trader. Just like I'm an old school hater of car alarms. VIX activity. So this is from one of the busier days that we've had recently. And I want you to notice something, like average volume is 750,000 contracts. Open interest is usually between 5 and 10 million contracts. You can get about anything done. Notice here the size of these trades. All right, so using options. So let's talk up now. I'm not going to dig too much into the futures. There are some cool ways to trade them. A lot of people like to do future spreads. All right. A lot of people like to do future spreads. So, you know, and somebody just said, this is beyond my pay grade. You know, one of the nice things about learning about a subject that is confusing or you don't understand is that it puts you in a position, I think, to understand where you are in the market and what you need to learn. Not knowing what you don't know is a very valuable thing. So if all I can teach you today is what you don't know, I will have done my job. So recall VIX options. The at-the-money strike is not the cash VIX level, but the futures. So right now, if I'm trading July options, the at-the-money option is actually the 12 halves. If I'm trading October, the at-the-money option is actually the 15. I like that. So one of the things to understand is that every month has its own at-the-money. Kind of funny, right? You know, it's weird to have a product where every month has its own at-the-money. So let's talk about trading short VIX. Then this is the way most people trade. Trading short is becoming a very popular trade among hedge funds and retail traders. Two main ways to get short is short call spread or long puts. Both have some good things. Let's talk about short call spread. You can sell an out-of-the-money call spread. And what you do is you execute a short call spread when you think the VIX may not move around or may be stable. So I like short call spreads when the VIX is kind of where it is today. You know, it kind of elevated a little bit and then kind of backed off. It's been kind of hitting 12 but doesn't seem to want to get over 12. So when I see that kind of market, I might look and say, boy, like a a short 15-17 call spread in VIX in July might not be a bad idea. You know, I can sell the VIX 15-17 call spread and get 20 cents out of it. That's not bad. I might be willing to do that trade. 10% yield, and you have to have the VIX get over 15. Something, if we look at our monthly chart, right? Remember the VIX over the last year? So here's 15. All right, so, you know, they'll have a limited income, but are generally pretty consistent. The one thing I will say, though, is that volatility tends to bunch. You know, there's an old saying, one of the things that's unique about volatility is that it correlates to itself. Do you know what that means? When something correlates to itself? All right, so correlating to yourself would be like if in basketball. So in basketball, if I make a free throw, my next free throw, whether or not I made my previous, has nothing to do with it. Right? In stocks, if Apple goes up one day, the likelihood of it going, you know, whether it goes up or down the following day is, you know, has nothing to do with it. With volatility, if volatility is up, it is more likely to be up again than to be down. All right, and then once it goes down, it absolutely does. But especially when you know, when it really starts to get scary, the way the correlation moves, it gets real scary. So basically my point is, if you get beat on a call spread, do you think it makes sense to jump back in? No. I'd rather sell a VIX, I'd rather sell a 15-17 call spread with the VIX going from 14 to 12 than a 15-17 call spread, even though I'll get more money, even though I'll get more money than a 15-17 call spread with the VIX going from 10 to 12. Right? So if VIX goes from 10 to 12, I'm less excited about selling a call spread than when it goes from 14 to 12, even though 12 is the same level. All right, trading short a long put. So this actually simulates a future, but it's you pay a little premium, and in return you get a capped loss. It will have some time premium to it. Premium is less for out-of-the-money spreads and out-of-the-money options, and it's really useful for a convergence trade. And that's betting that a future will grind lower toward the VIX cash. So what's a convergence trade? Well, let's take a look at July. July future is 1260. The VIX cash, right now, the July future, I'll give you the closing price. So the July future is 1240. The VIX cash settled 1090. What is 1240 minus 1090? Yeah, so it'll spike for 2 or 3 days. So the first day, the second day it'll spike, then it'll finally come off. That's when maybe you can get in. All right, so what's this difference? What's 1240 minus 1090? And if you guys can't answer this, you should. My kid can answer. My 7-year-old was just doing more complex math than that. $1.50. Yeah, $1.50. All right, so what do you think the price of the 12.5 put is in July? without looking, no cheating. Knowing there's a ton of time left. So it should have some time premium, right? Yeah, you'd think it's worth $1.20. So now a trade I really like to do, and I do this, we do this in the fund. I'll buy like the July 12.5 puts for 25 cents, and I'll sell the July 10 puts at a dime, or the July 10.5 puts at 20. And I'll buy, so if I'll buy a $1 put spread, a $2 put spread for $1 that is already $1.60 in the money. All right, so trading long. When using options to trade a higher VIX, typically the most favorable trade is a call that is at the money or out of the money, or just out of the money, first strike out of the money, and then buying that at the money call and selling a further out of the money call, bullish verticals. That is the way to, if you want to just play straight long. And it's because of vertical skew, the payout on call spreads tends to be more favorable than straight calls. And let me show you here. So August, VIX August, the August future is, was around, I think 13 and change. 13.10. All right, so I can buy a 14 call for $1.40 and sell a 24 call for 45 cents. Now, at the time of this, the VIX was around 11. So I'm getting a 10-point vertical for less than $1. All right. So I'm getting a 10-point vertical for less than $1. You think that's favorable risk reward if you think the VIX is going to spike? You like getting better than 10 to 1? Yeah. I mean, $1.40 is fine, but why not buy, I get to buy 80% implied volatility and sell 120% implied volatility. There you have it. All right, so let's talk about the volatility in ETNs. Is that favorable premium on out of money because so many people are paying for insurance they don't demand it will pay off? That is correct. That is correct, George. That's the theory behind it. People are looking for a dollar price. There's that hedger named 50 Cent that goes out and buys 250,000 at a clip 50-cent options. So volatility in TNs. So as trading in the VIX futures has become more and more actively trading, we've developed these ETNs. Each of them has a stated purpose. However, due to term structure, they have unintended consequences. So do you guys know who King Sisyphus was? He was made to push a boulder up a hill every day. And then every night it would roll aground, and he'd have to push it to the top again. And that was because of his own hubris of thinking he was more clever than Zeus. Thus, pointless activities are some kind of Sisyphean. Well, right. So let's talk about VXX, which is the most famous of the ETNs, or ETPs. And it's the iPath short S&P 500 term VIX futures, ETN, and attempts to replicate being long a VIX future with 30 days to expiration. An intent of the fund is to allow traders to get long or short, near-dated forward volatility. The long fund does this by constantly rolling out of front-month futures and into second-month futures. So, would you run a business where you bought a product for $16.10 and sold it at $15.50? So, there's a term called roll yield that is talked about, and that's really incorrect, right? The way the VIX futures work, the VXX works, is at 30 days to expiration, in this scenario, it would be carrying 100% June future. All right, well, over the next 30 days, remember we talked about the convergence trade, where does the June future have to end up? June future is 16.10. Where does it have to end up? No, it has to end up at the cash index. So what it does, and remember, it's trying to constantly be 30 days to expiration. So what it's really doing is long the June future for 16.10, and then it's selling a little bit every day at a lower and lower price. Then it takes the money that it spent and buys this guy. So that's really what is happening. There's no such thing as roll yield. You don't get roll. You get convergence. But the result is kind of ugly. So if you'd bought VXX on its opening day, you would have spent $25,000, and it's currently worth $13. How about that? How's that for a winner? You're only down 99.95%. So it's rolling itself to zero. It sounds like the government, huh? VXX should not be held for more than a few hours if VIX futures are in contango. VXX does exactly what you expect. VXX does exactly what you expect. So it's great to trade intraday if you think volatility is going to go out, spike. If you think volatility is going to move today or tomorrow, or volatility is going up, VXX is great. It's just if you're trying to buy and hold it, you're going to lose. Question, do you think VXX put options fully compensate for the degradation pretty much guaranteed in VXX price? I do not. And that is part of the assumption of delta neutral trading, George. Which is a theoretical thing that you have to get into. So the difference is, the guys trading it, they're not taking any delta. They're trading the volatility. You're putting on delta risk. So VXX can actually be an excellent hedge against rising volatility. Or excuse me, an excellent hedge against falling volatility. And there are portfolios where ask me at the end of the day, at the end of the discussion. I didn't see it. But it's a poor hedge against rising volatility unless you wait for volatility to rise. Different products, similar result. VXZ, midterm, not as bad. All right. UVXY, double long, optionable, complete garbage, worse than VXX, UVXY. TVIX, double long, levered, not optionable. All right, I trade a lot of bare UVXY stuff. And then probably the best of the bunch is XVZ, but even that's not that great. You know, someone asked if I would buy and hold one long option or one long index. What would it be? It would probably be XVZ if I had to buy and hold something. All right, approaches to ETN options. All right, so here's a trade that I'll do. Actually, I put something on similar to this, not exactly the same. I do have like an IRA strategy where I buy puts in UVXY that are at the money expiring 18 months to 2 years from now. And then when UVXY announces a reverse split, I take the trade off. All right. I unwind when the VIX curve flattens. All right, and I will not hold when the VIX curve is backward. That is my what I call my set it forget it IRA strategy. Now here's another one that I'll do for a short-term play. It's my leveraged play. So this is one that I was looking at today. So if they go into backwardation and not in contango, you don't want to be in UVXY. You don't want to have that long-term plan. As long as it's a contango, you're good to go. So this is my kind of leveraged play. In UVXY, I'll buy, I did something similar to this today, not exactly the same. You can buy 10 of the 10.5 puts. You buy 10 of the 14 calls, sell 20 of the 18 calls, buy 10 of the 22 calls. Net cost is $1.30. All right, I did this at the time. It was 10.5. And UVXY settled the day 10:30. I believe the trade was already up nicely at the end of the day. Yeah, it was up about 10 cents by the end of the day. It was up about 10 cents in an hour. And it's a great trade when vol's kind of high, but you think it's going to collapse. So this morning when the VIX was at 12, this is a great way of playing. Well, I think the underlying is going to drop right back. But if I'm wrong, I'm going to benefit. Because you can see up here, this thing keeps going up to about 18 before it drops. So that's like my little leveraged play. All right, now, the inverse ETNs. Now, these things kind of have the opposite. You have XIV, which is the inverse of VXX. ZIV is the inverse of VXZ, and SVXY is the same as XIV but is optionable. So they actually have some sort of long-term gain to it. So one of the things for kind of set it and forget it people is that ZIV is great for a passive strategy. Buy and hold, forget about it. All right. It is slowly rallied. It doesn't have some of the volatility issues with XIV. But it should still be converted to cash when things go crazy. All right, so I think Shah, Darren, that would be the answer. How much risk do you think there is in these ETN products? What do you think about the new VMIN and VMAX? Those haven't traded enough, unfortunately. They're not terrible. I've been watching them. They're not terrible. They're better than some of the other things I've seen. So I need to see the volume up. But you can see ZIV over the last year. It's had a nice run. And it's much smoother than XIV. All right, so in summary, VIX options have unique characteristics. Each has their own underlying. IV and VIX are correlated, bear and bull plays, and play the spikes. All right, so here's what I'm going to want to tell you. So Saturday the 24th, Can you hear me now? Did we lose me? Can you hear me now? I'm back. All right, good. So Next Saturday, the 24th, we're going to do almost about a 4-hour webinar. It's going to be close to 2 hours on VIX, close to 2 hours on the ETNs, and we're going to really dig into trading strategy. We're going to look at the inverse ETNs in detail. We're going to look at trading UVXY options, trading VXX options, trading VIX options. I'm going to teach you how to set up a consistent hedge that will not make you lose your shirt in VIX if you think volatility is going to rally. Now, that course costs $197. But people that are Option Pit Live subscribers get to go to my Saturday classes for free. Most of them. Well, why is that important? Well, Steve just dropped in an offer where you get a 1-month trial of Option Pit Live for $17. $17. So what is Option Pit Live? It's really we put on in the morning we do a kind of 5-minute discussion on 5 to 8 stocks we're watching. Then I do about a 15-minute discussion narrowing that down to 3 really good trade ideas. Then kind of midday, I may or may not pick one of those ideas to then add to my strategy letter, which I then follow and manage and keep track of the P&L. In addition, you get some email support. You get access to the special Saturday classes. You get access to email support with me, some of my traders, our room. It's a really interesting. Really, this is a steal. $17, and you're getting $325 worth of stuff. If you go to my store, after the June 24th, if you want to buy this thing, it will cost you $297, just the course. You get the course for free if you buy the $17 trial. Someone explain to me why you wouldn't try that. $17, that is less than I spent when I buy McDonald's for me, my wife, and my older son. They're at Lucky Dog. And it will be recorded, and as long as you view it before your trial runs out, you will be able to view it. Right? Kind of idiot-proof, right? $17. Then let's say you like the course. I mean, if you keep your subscription active, we do about 10 Saturday classes a year. All right, your monthly reoccurring is only going to be $97, not $125. So for $97 a month, you're going to get these 10 courses that we do, which over the life of the year we charge $2,400. And there are people that buy them, and you're going to get all the access to our strategy, and we'll teach you how to buy options, which is great. Any questions? All right, and by the way, everybody that attended this and registered is going to get a complimentary copy of my ebook, The Fear Gauge. So it'll cover some important topics that we touched on here today. George, we do a lot of conditional trading, but I guess so. Yeah, everyone should know how to trade volatility. I guess so, but it's not something that yes, I would say yes, but I'm gonna say that probably not in as tightly describable as the type of stuff you're probably doing here at Candlestick. Does that make sense? Because volatility is a lot more ethos, if you will, than candles. All right. Any other questions?
Mark, very good information.
Thank you very much, Steve.
Yep. So everybody, for $17, you can't even get 3 cups of Starbucks coffee for this. So you're going to get
It's
a lot
insane.
more information. Yep. Get a lot more information than you can anticipate. So everybody should try it, because if you find something that really fits into your trading style, I mean, this is the place to find out what works for you. So with that, Mark, thank you very much. This was good stuff. Everybody, give it a try. You're looking at $17. Basically, don't have anything to lose. So with that, everybody have a good evening. We'll see you in the chat rooms.
All right,
Thank you,
sounds
Mark.
good.
Good stuff.